We've decided to change the format of this channel to focus on economic issues affecting the world today. Let us know in the comments section below if you like the new direction of the channel or have any suggestions about what you want to see. Today we're looking at the topic of inflation, and specifically if the US is at risk of experiencing hyperinflation. The US Federal Reserve reacted dramatically to the COVID pandemic of 2020 by setting interest rates to near zero and injecting trillions of dollars into the economy through quantitative easing. At the same time, both the Trump and Biden administrations have approved trillions of dollars worth of fiscal stimulus in the form of direct stimulus payments and enhanced unemployment insurance. Many market observers, including billionaire hedge fund manager Ray Dalio, have warned these policies will inevitably result in a dramatic increase in inflation in the coming years. And we are starting to see inflation in the data. In the month of May, the Consumer Price Index, or CPI, increased 5% year over year. It is important to note that this year-over-year number is compared against May of 2020, when the lockdowns were in full effect. This made the inflation number unusually low and skews the year-over-year comparison for this year to the upside. But it is undeniable that there is a clear upward pressure on prices. As people are finally allowed to go outside to shopping malls and restaurants, they are unleashing their pent-up demand and spending their stimulus money. As inflation rises, the value of the purchasing power of the US dollar will decrease, thus eroding the wealth of US households. The Federal Reserve says the recent uptick in inflation is transitory and purely the result of pent-up demand in the reopening. However, many fear the Fed is wrong and the US is at a risk of experiencing hyperinflation, which will wipe out the savings of ordinary people and devastate the economy. Obviously, the first thing to look at with inflation is the money supply. The more dollars the central bank prints, the less each one is worth. At the beginning of the pandemic, the total M2 money supply was $15 trillion. The Federal Reserve printed an additional $4 trillion, bringing the total up to $19 trillion, a 27% increase. M2 money supply counts all paper currency in circulation, as well as checking and savings accounts in banks. Just looking at the growth in the money supply, you would expect the CPI to increase by 27%. The CPI measures the price of a common basket of goods people would buy. It includes things like food, housing, healthcare, and entertainment. Over the past year, the amount of goods in the economy hasn't gone up dramatically, but the money supply has. Therefore, there will be more money chasing the same amount of goods. This will bid up the prices of the goods and cause inflation. However, it's not quite as simple as that. For increased money supply to translate to inflation, people have to actually go and spend the money. During the pandemic, people were stuck at home and didn't have many opportunities to spend money. They can spend a little bit on food delivery and Netflix subscriptions, but this is generally far less than what they would spend on movie theaters or shopping malls in normal times. During the lockdowns, the personal savings rate of US households increased dramatically to a peak of 34% and has averaged almost 20% during the period. This is more than double the roughly 8% savings rate before the pandemic. People fortunate enough to keep their jobs during the lockdowns saved a large portion of their earnings. Many people who were laid off also saved a large portion of their unemployment benefits in stimulus payments. People used these savings to buy stocks. Thus, the increase in money supply caused inflation in financial asset prices instead of in the real goods market. This is why the CPI growth rate actually fell below the Fed's 2% target for the majority of 2020. Now that the economy is reopening, we should start to see CPI increasing, but the question is by how much. The money supply increased by 27%, so CPI could theoretically grow by the same amount. The most analogous time period to the current situation is the Great Recession of 2008. During this time, the Federal Reserve pioneered quantitative easing and increased the M2 money supply by 13%. At the time, many people thought this would result in runaway inflation once the recession was over. While CPI growth was volatile during the post-recession recovery, it averaged pretty close to 2%, which is the Fed's target. Thus, the dire warnings of hyperinflation did not come to fruition. There are a few key differences today. Firstly, the scope of monetary policy support was far greater during the pandemic. In 2020, the M2 money supply increased by 27%. This is twice the percentage increase that was seen in 2008. Another key difference is fiscal policy. During the 2008 recession, the government passed some stimulus programs, including refundable tax cuts and infrastructure programs. Between the Bush and Obama administrations, the total stimulus added up to a little less than $1 trillion. Between the CARES Act, signed into law by Trump, and the American Rescue Plan, signed by Joe Biden, the federal government allocated roughly $4 trillion to fiscal stimulus. This is 4 times what was spent in 2008. Keep in mind that this doesn't even include Biden's proposed infrastructure plan, which may be passed in 2021. The 2008 stimulus only partially offset the economic decline, and personal income decreased by 2%. During the pandemic, the stimulus more than offset the decline. Boosted by stimulus payments and unemployment insurance, aggregate personal income has increased by more than 10%, despite millions of people losing their jobs. The enhanced unemployment insurance has created a situation where many people make more money staying at home than they would if they went back to work. This has caused unemployment to remain stubbornly high despite the economy reopening. Many service sector companies are finding it difficult to find workers and have been forced to raise wages. For example, McDonald's recently hiked its wages nationally by an average of 10% in a desperate attempt to coax workers back into their understaffed stores. They will pass these costs in the form of higher prices to the consumer. This will increase CPI inflation. Additionally, low interest rates have boosted real estate demand to record levels. To meet demand, home builders are firing on all cylinders to build new homes. This has led to violent price increases for key input materials such as lumber and steel. This will seep through the economy, further pushing up CPI. Given the unprecedented nature of the pandemic response, it seems likely inflation will increase at a much faster pace compared to the rather benign scenario after the 2008 recession. The key question is, how high will it go? Will the inflation be transitory like the Fed predicts, or will it spiral out of control into hyperinflation? The key determinant of inflation persistence is inflation expectations. If workers expect prices to rise by, say, 5% a year, they will demand a pay raise of 5% to offset this and keep their real wages constant. Businesses will also increase their prices by 5% to offset their higher labor costs. Thus, inflation becomes a self-fulfilling prophecy. Prices rise by 5% because they were expected to rise by that much. Even if the Fed stops its money printing, inflation can continue to be elevated for a few years as the dynamic of inflation expectations is highly persistent. For example, in the 1970s, the US experienced a period of high inflation as a result of oil price shocks and loose monetary policy. In 1979, inflation exceeded 10%, and US President Jimmy Carter appointed a new Fed chairman, Paul Volcker, to fight the inflation. Volcker immediately raised interest rates to as high as 20% to cut inflation. While this did work, ingrained expectations kept inflation stubbornly high, and they didn't return to the normal levels of 2% until mid-1982, about 4 years later. The current inflation the US economy is experiencing could cause inflation expectations to reset higher and become a persistent problem. The New York Fed conducts a monthly survey asking consumers their prediction for inflation 1 year out. Over the course of the pandemic, expectations have risen steadily and currently sit at 5.3%. This is the highest number recorded in the past decade. We should expect consumer prices to continue rising at above the Fed's 2% target for at least the next few years. An average inflation rate of 5% to 10% over the next 3 years seems like a reasonable prediction given the monetary and fiscal policy, as well as increasing inflation expectations. While this is not hyperinflation by any means, it will degrade the value of cash significantly. The good news is, it's pretty easy to protect your wealth from inflation by holding stocks instead of cash. A stock is an ownership stake in a company that has real assets. With inflation rising, the company will be able to raise their prices commensurately and maintain their real earnings. So while inflation will degrade the value of cash and bonds, stocks will maintain their real value as long as the fundamentals of the underlying company remain strong. In fact, companies with a lot of debt can actually see their real earnings increase during periods of high inflation. Their nominal revenues will rise while their interest payments remain fixed. This increases real earnings and allows them to return more capital to shareholders. So while inflation is big, and it's probably here to stay for multiple years, it's not something stock market investors have to be too worried about.